Welcome back to another episode of Making Sense with me, John Napolitano. We're here to break down the big questions high net worth families face. You know, the ones your investment guy never talks about. No fluff, no finance 101, just straight talk to help you make smarter decisions and keep your wealth working as hard as you do. Let's get to it. Hi, I'm John Napolitano, your host of Making Sense. Today, we're going to kick off with a talk about tax planning. And my guest is Mr. Bill Clement, managing partner of South Coast Financial Partners. Bill, how you doing today?
Doing great, John. Thanks for having me on.
You getting pumped up for another tax season or what?
Yeah, we're pumped up. We're ready.
Sounds good. Now, the purpose of this podcast is to kind of deliver advice that's not your mainstream kind of $2 window advice. It's stuff that people with money, with businesses, with stuff going on are not going to hear it through the ordinary channels. So our job is kind of to enlighten them a little bit. And most of my wealthy clients are thinking, dude, what are you doing? Isn't tax planning something you do in kind of like April or at the end of the year? So help them out with that.
Yeah, tax planning is something that unfortunately is a foreign concept to folks, and it's really an undiscovered benefit. And once people realize how much work is involved and what's to be gained, they really embrace it, and it's something that really takes place more during the year. Our mantra and our mentality is that most of the tax work and the value in tax services it is done usually in the third, fourth quarter of the year. We really want to work with our clients, understand what's happening during the year, and also kind of in their broader financial lives, and tied in with their wealth advisors, their estate attorneys, and any other key players in their financial life to put together a comprehensive plan and make decisions and model those decisions out and try to understand what's the best course of action for them well before the end of the year. As we like to say, before the clock strikes 12 and you're essentially out of time, we want to have those plans well defined and execute on them. And then by the time April rolls around, March and April, we're just executing on the plan. It's really a data entry, it's a preparation function, but we really shouldn't be having those planning discussions or being surprised by anything that's happening within that first quarter of the year as we're preparing your tax return. The best process is to be in front of those things and to have those thoughtful discussions and understand your options to maximize your tax opportunities and reduce your liability well before the end of the year.
You know, when I think taxes, when most people think taxes, I'll say, not me. When most people think taxes, they're thinking of the tax return, that thing you file in April or later, if you have a complicated return, income tax return. But I think of this. I think of your federal income tax return, your state income tax return, any gift tax returns, and ultimately the last return you'll ever file, your death tax return. So I view it that, lifelong tax planning is a blend and a balance between income taxes, gift taxes, death taxes, business taxes. And it's not now or never. It's now or later, because many times you're just trading off one tax for another tax. So it's not really a one and done. Let's do your tax plan for 2024 or 2025, and that's it. We're rolling forward. We're visualizing many years out, future gains, future sales of businesses, future acquisitions of equipment and businesses and things like that. Do you get involved in helping people coordinate the big picture like that?
Absolutely. And, most people think of their tax preparer or advisor as a once or twice a year relationship. And for some people, that's okay. That's enough. But if you have a business, you're a business owner, if you have wealth that you need to protect, or if you have complex issues and that are important to you, and there are unanswered questions in your financial life, you really need to have more than once or twice a year meetings with your advisors. And it's really your tax advisor, and it's also your financial advisor, your estate attorney, all those people I mentioned earlier. The interesting thing is that all those components and different tax returns that you mentioned are all different parts of the tax code. And the rules and laws applied to each of those are very different. And there's a different set of opportunities and a different set of rules that you have to play by. And in a situation where you have an administration change, whether it's a new president or new tax law that's coming out, those things can change. Maybe one thing will change versus all of them, but having a good sense of how those changes impact those different potential tax returns is also really important. So you might have the best plan. You might spend a lot of hours and money on it with all of your advisors, and you publish that thing. And then a year later, the tax code could change, and it requires looked at again. And it might mean some new planning, and it's a little bit cumbersome and it can be painful at times, but it's worth it. And to know that you are maximizing your opportunity and you're not paying more than your fair share.
A lot of people may view tax planning as, oh, you're just trying to screw the government out of money. That's not it at all. In fact, I'd like to read a quote from a famous former judge of the United States District Court in the Southern District of New York. His name was Billings Learned Hand. I heard this first when I was getting my master's degree in taxation. And here's the quote. So pardon me, but I'm going to have to read for a moment. According to Judge Learned Hand, anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to be chosen that pattern which will best pay the treasury. There is not even a patriotic duty to increase one taxes. Now, obviously, you could tell that's an old quote. The is, his. Sorry, ladies. That was not me. That was Judge Learned Hand. And that quote came from sometime in the early 1900s. This guy died in 1961. So that's kind of our MO. That's how we're operating, and that's where we're coming from in this. So now let's get into some of the cool things that we can talk about for people with tax planning. And let's talk about, here's something that a lot of people don't think of, and that is Roth conversions. Roth IRAs are known to be for people that don't make a lot of money. Tell me how a Roth conversion can be helpful to a wealthy family.
Yeah, wealthy family, there's a couple of ways that they can be beneficial. And what's interesting about Roth IRAs is that they're constantly under scrutiny by Congress and folks that lobby and create legislation because they're known for being an extremely powerful wealth building tool. And the ultra wealthy all have something in common, and that's a sizable Roth IRA. And the way that it can be beneficial for a wealthy family is really looking forward into your future and understanding your tax bracket today and your tax bracket in the future. If you're able to transition funds that may be today in a traditional IRA that were tax deferred and roll those into a Roth IRA, which can grow tax free and pay the tax today at a lower rate versus in the future, you can really save twice. You can save on the marginal tax savings in the future when those funds are ultimately cashed out, and you've grown those invested dollars tax free from the point that you're converting them. So it's a really powerful wealth building tool. There's a lot more that can be said about Roth. There's even something called mega backdoor Roth, which is another interesting opportunity, complicated and also very logistically challenging, but another great wealth building tool. So there's more to that story, but it's certainly a powerful tool.
Let's talk about a myth. Myth is, oh, when I retire, I'll be in a lower tax bracket. That may be true for some, but have you ever seen that happen for a wealthy family?
Never. I mean, unless, barring any unforeseen circumstance or something really terrible happening in your life, which, it's unlikely that a family that has a certain amount of wealth today is going to end up with less wealth in the future. You probably have good advisors. You've made smart decisions, and winners win. And you're likely going to keep winning. You're going to keep growing your asset values over time. And the reality is that in the future, there's a consensus that the tax rates will always be higher in the future. It's a good planning tool to kind of think that way. So to John's point, when you start thinking about a Roth conversion, sometimes it's better to pay the tax today, knowing what your rate is today, versus waiting until you're forced to take those retirement funds out through RMD and paying more tax in the future. So it's really a balancing act of paying now versus later, and which tax bracket will I be in? Am I going to be higher now, or am I higher later on?
So let's make believe you're in the top bracket today and you expect to be in the top bracket forever. I can see a scenario where it might still be worth doing a Roth conversion given a couple of factors. One is you've got a little bit of runway for life expectancy. The second is if you are about to make an investment in something you have high expectations is going to perform phenomenally well. Let's say like a new company or a private equity situation where you have reason to believe this business is going to really thrive. That seems to make sense under any conditions, doesn't it?
It does. Yeah, absolutely. Anytime that you are making an investment with significant upside, if there's a way you can do that with your Roth, that is an extremely powerful wealth building tool. And those ultra wealthy folks that I mentioned earlier, of which sometimes their names hit the headlines, that have hundreds of millions, billions of dollars in a Roth, that's exactly what they've done. They funded the Roth as aggressively as the tax code allows, and they've invested it as aggressively as the tax code allows. And they hit some winners, and next thing you know, they've got hundreds of millions in their Roth. And guess what? Uncle Sam doesn't get any of that because it's tax free.
So this maybe underscores, God forbid you have a long runway as well, maybe Roth IRAs for children. How can you get a Roth IRA set up for a child?
It's very simple. Setting up a Roth IRA for your children is one of the first things that we recommend for especially our younger clients that are business owners that have some extra cash flow and they're really thinking about their children's future. Uh, Work with your wealth advisor, your financial planner. They can typically open that Roth account for you in a few minutes with some very simple information. And the key is that your child has some earned income, and that can be if you're a business owner, you can issue them a 1099. You can have them do some part-time work for you, whatever value they can generate, helping you with your business. They generate some earned income, and then as long as they generate enough earned income to maximize the Roth, you can take that same cash that you would have paid them and put it into their Roth IRA on their behalf, and that money starts to grow from when they're very young, young teenagers.
So are you saying, is it possible to take your 1 month old child? Now, obviously, that kid can't do any work, but if you were to, let's say, choose to use your son as a model for some of your firm's advertising efforts on things that people with families may do, you could compensate that child for that. That child would obviously have to file a tax return, and then at the whopping age of 12 months old, establish his first Roth IRA.
Yeah, it's tricky. I mean, the IRS is there's a definition of earned income, and you have to play inside the lines in terms of what's available. But as soon as
Yeah,
you
heck
have the
yeah.
ability to do that with your child, and they can generate some value and earn the income, whatever that service might be, then it's definitely an option for a business owner and their kids.
Bill, let's talk about basis. This is a technical term that we're going to dumb down for high net worth people. Basis is basically the tax cost of your asset. It may be different than your actual cost because in real estate, for example, there might be depreciation or other things that reduce your basis. But, how important is it for a client to be aware or their advisors to be aware of the basis of their assets?
This is something that comes up. It comes up very frequently with us and our clients, and basis is it's a tax calculation in essence, and that's the trickiest part I think for people to understand. You hear the word basis, you could have you could have partnership basis, you could have basis in your corporation, and then you could have basis in property that you own. It could be your primary residence, it could be your rental property, and ultimately that number, it's calculated a very particular way, and it's different for each of those different assets that I mentioned. But that number is such an important part of the tax calculation when it comes time to sell that asset or transfer it or gift it, whatever you might be doing. When that asset is moving from you to somewhere else, that number is extremely important to know. And knowing it in advance of making the move is even better because now you're planning around that and you're reviewing the basis of that asset versus all the other assets that you might have. And in the case of your estate plan, your basis is a very important because as part of your estate plan, your assets will step up when you die up to the market value that they're worth as of the date of death, and they will change their basis and increase to that date. Even if you had a house that had fully depreciated and it was worth $0 in your portfolio, it's now stepped up to that basis, date of death, whatever the market would value it at. And that's an extremely
So
powerful estate planning tool.
to put this into a plain English term, there might be some assets that you're better off dying with than getting rid of before you're dead, even if you're a high net worth individual or family.
Absolutely. Absolutely. It's something that requires careful review by your estate planning team and your tax advisors to make sure that it sounds somber, but you're dying with the right assets in your portfolio. There's certainly a benefit to gifting some out before you die and, making some moves, but dying with the right assets can make a huge difference in your estate plan. And knowing your basis now is really important. It does require digging up old documents. What did I pay for this property? How much have I put into it? Have I depreciated it because it was a rental property? These are all questions that sometimes require going into a banker's box and storage, and it's a lot easier to do that now when you have the time and you don't have anything major in your life going on versus being forced to do a last minute estate plan and trying to figure these out when someone's sick or injured, or they need your time and your focus. They don't need you digging in a banker's box in a storage container. So all these things can be addressed ahead of time.
So we talk about basis, et cetera. A lot of high net worth families are charitably inclined. Some are very charitably inclined, and some just token charitably inclined. Tell me about basis and low basis and the whole idea of gifting appreciated property.
Yeah, if you're a wealthy family and maybe charitable gifting is something that's important to you, it's something that you want as part of your estate plan. It's very noble. It's a great thing that we see a lot of wealthy families have in common. They want to do right by their kids. They want to do right by their close family and relatives, and they also want to have a substantial gift. And the idea is to get that value out to that charitable foundation, whatever it might be, that charitable organization. So when we're looking at the opportunities, let's say they have some stock, some Apple stock they bought in 1988, and obviously that stock has grown significantly, and the basis in it is really low. There's a really large appreciation in that stock since 1988. If they were to sell that stock, right, there would be a massive capital gain on the sale that would require a lot of tax to be paid. So the net give would be a lot lower because you have to pay the tax first and then gift it. And what the charitable gifting allows you to do is gift it, whatever that is, at its fair market value and take a tax deduction of the fair market value against your income taxes. Now, if you're in the highest tax bracket and 30, 40, 50% tax bracket, depending on where you live, that's a substantial impact in your overall tax burden. So it's something that we like to look at very frequently.
I like that idea a lot. And if you just were going to make, let's say, a little gift, maybe $1,000 to the local Little League or something, kind of a pain in the butt to use shares of Apple stock for that. But that might be a good reason to use a donor advised fund. A donor advised fund will accept your appreciated securities. So you do that into the donor advised fund, and then you can make your little dribbling distributions or your dribbles of contributions out of the donor advised fund. That's another great way to save taxes. Moving
Absolutely.
on to business issues, Bill. When owners of businesses think about the future and maybe a sale and a liquidity event and taxation, et cetera, knowing that that sale is going to yield way more than they need to complete their life's goals, let's talk about getting the next generation involved and gifting shares and discounting and all that other good stuff. So make believe you and I own a business worth $100 million.
Cool.
Someday that will be the case. And we know that that's like 50 million more than we need. And we want to kind of start making some gifts, whether it's charitable, but let's talk in this case, family. And you want to give a minority interest to your 1-month-old child. Talk to me about the discounting and how to do that in the most tax efficient way.
Yeah, I mean, valuations of a business are pretty subjective, and the IRS has its prescribed way of valuation of a business and equity of a business. And depending on the situation you're in, there's different calculators that they like to use. But if we're gifting or transferring ownership of a business that we own to a family member, even if it's a minority stake, we're going to do our best to value that business in a very tax efficient way. It's a minority interest that has a lack of control. So we're certainly not going to value it at full market price and incur the tax liabilities at full market price. We're likely going to discount that valuation as much as we reasonably can. And we'll often sell that stock to the family member And we might even do a loan back from them. So they have to pay you back at a minimum interest rate, which is established by the IRS called AFR. So they'll pay us back at a very minimum interest rate. And if they are somebody that a close family relative, you may also decide to gift them the annual maximum amount possible. Let's say 18,000 a year, which might even cover the loan payments back. So there's really tax efficient ways to kind of sell them a minority interest in the business. That's just one example. There are so many other examples, and it really depends on the facts and circumstances of your life. We work on this all the time. Every deal is different. Every deal is nuanced, and the valuation of every business is different. But there are many ways, if you work with your advising team, to really structure this and get creative. That's just one example.
And if you're going to use the value of your closely held business as the basis for a gift, wouldn't it make sense to get a formal business valuation, one that would hold up in court?
Absolutely. You can hire an independent accredited business valuation specialist. There are some credentials out there that you could look for that. But essentially, that third party valuation will be based on a number of factors. It will be the cash flow of the business year over year. It will be based on the strategic multiples and valuations of businesses like yours that might be selling in the public market or even the private markets. It'll be based on a number of different factors. And ultimately, there's a lot of subjectivity to what number comes out of that. You, as the management, have to influence that valuation. The business is either going up, it's going down, it's staying flat. All those things are part of that calculus. But having an independent value is a must. Any business that's worth over $1 million should have a valuation done. It's a lot cleaner. It's a lot easier. It's attached to any potential estate return as well to back up those numbers. Definitely worth it.
And remember, dislocations in the market might be a perfect time to do a valuation and make some gifts. An example of that, during COVID, some businesses just got beat up big time, and they were concerned about their future. So if you had a business that you kind of thought you'd be able to get through that tough period, and it commanded an extremely low valuation during that time, that would have been an ideal time to make gifts. Because as you saw, as soon as COVID ended, many of those businesses not only sprung back, but they sprung back stronger. One last topic I'd like to raise, Bill, and that is a lightly covered issue, and that is state taxation. Now, this may not be an issue for many people, but if you're in Massachusetts, New York, Connecticut, Virginia, California, or these known high tax jurisdictions, some people look to change their residence and change their domicile. Talk to me about the benefits and or the pitfalls of changing your state domicile.
Sure, definitely. This has been probably, I would say, the hottest topic that we have with clients in the past 3+ years. I'd say in a post-COVID world, for those high earners and folks that even have large estates, they're all asking the state question, and it's a great question. And I think depending on where you live, it could be something that is where states are pushing you to ask that question of your tax advisors. So every state has its own tax code. We all kind of know generally the IRS tax code. You hear components of that. It's a little more familiar to the average person, but the states have their own tax code. Sometimes it runs parallel to the IRS, and it's easy to understand. But there are nuances and differences between how the state taxes you and how the federal government taxes you. And unfortunately, every state does it differently. And that requires really subject matter expertise with someone that understands the state you're in and how they're taxing your income and also how they're taxing your estate. And a common question we've been getting recently is, how do I get out of Massachusetts, who implemented a millionaire's tax, right? An additional 4% on top of the 5%. I'm paying 9% on my income over $1 million. What the heck just happened? How do I get out of here? And it's a lifestyle question. It's a personal question. Do you really want to move? What other state could you live in? Florida sounds great. No state income tax. But is that really where you want to live? It's hot. There's hurricanes, but it's a beautiful place. Let's just say that works for you. Great. You can buy a plane ticket, rent an apartment, buy a house. You've officially moved your physical presence there. Massachusetts is not going to give up that easily. So we've crunched the numbers. We've looked at everything. You're going to save $100,000 a year by moving to Florida and earning your income there. Massachusetts is still looking at you as an outgoing taxpayer very closely. And there is a very defined checklist. John, I know that you have one on your team and you've worked with clients on this, but there is a checklist of things that you have to do to kind of prove to Massachusetts that you've left. You've effectively left, and they can't reach in and claw some of that taxable income back. So in the first few years after leaving a state, it is tricky, and Massachusetts is one jurisdiction, but most other states are the same. They want to see that you've moved. Your entire life is in that new domicile, in this case, Florida. You get your groceries there. You're going to the salon. You're visiting family there. You know, all your credit card charges are there. You're registered to vote. You have a new license. All those things are important. And it's really tricky. And recently, Massachusetts has been very aggressive in pursuing those outgoing taxpayers because they were such a big part of the tax revenue for the state. But these are the decisions that the state's making, and they're going to have to live with that.
So it obviously is more than the 6 months and a day that everyone thinks it is. And it's not something to take lightly. If you're thinking of changing domicile, changing states in 2025, reach out to either of us through email, call, whatever, and we'll get you the checklist of things that you need to start working on now to make sure that 2025 is done properly and it doesn't bite you in the butt sometime in the near future. Bill, maybe this is a subject for a future podcast, exclusively the issue of domicile. So for today, I think it's time to let people go do something else now, and you can go back and work on your client work. So I want to thank you so much for joining me today. I know we'll have you back throughout the year, and I wish you a great tax season. Thanks, Bill.
Thank you, John. I appreciate you having me on.
Oh, my pleasure. Thanks for tuning in to Making Sense. If you got something valuable out of today's episode, share it with someone who'll appreciate it. And don't forget to subscribe. One last thing. If you love the show, open your app and give the show a 5-star review. Until next time, thanks for listening to Making Sense.
The views expressed on this podcast represent the opinions of each speaker and are subject to change. These views are not intended as a forecast, a guarantee of future results, investment recommendation, or an offer to buy or sell any securities. The information provided is of a general nature and should not be construed as or used as a substitute for individualized investment, tax, financial, or legal advice or service to any person. Financial planning and investment advisory services are offered through U.S. Financial Advisors, a registered investment advisor. Certain representatives of U.S. Financial Advisors are also registered as representatives of Great Valley Advisor Group, a registered investment advisor. To learn more about Napier Financial, please check us out at napierfinancial.com.